August 7th, 2025 will be remembered as a day of reckoning for Fortinet. The stock didn't just stumble, it plunged off a cliff. From a Wednesday close of $96.58, the stock collapsed to an intraday low of $70.12, clawing back only slightly to finish the day at $75.30. That's a 21.9% crash in a single session, and at one point, a jaw-dropping 27% drop from the day before. And here's the part that left many investors scratching their heads. Fortinet had actually reported a strong quarter. For Q2 2025, Fortinet posted revenue $1.63 billion, up 14% year-on-year. Billings $178 billion, up 15% year-on-year. Earnings per share 64, beating expectations of 59. That's a 19% jump from the same quarter last year. On an ordinary day, these are numbers that would send a stock higher. But then came the comment. The one line in the earnings call that flipped the entire narrative. CFO Christian Olgart revealed that 40 to 50% of the company's massive firewall refresh cycle is already complete. To the market, that meant one thing. The surge in hardware sales fueling Fortinet's growth may be more than halfway over. Within hours, the downgrades began to roll in. Morgan Stanley trimmed its price target to $85 from $100. Piper Sandler downgraded Fortinet's stock rating to neutral on renewal concerns, highlighting uncertainty in Fortinet's outlook in the next many quarters. KeyBank slashed its rating from overweight to sector weight, warning of diminished visibility for the next hardware cycle. Each note amplified the fear. Selling turned into dumping. Dumping turned into a freefall. By the closing bell, Fortinet had shed more than a fifth of its market value in just one day. The question now is this: was it a violent overreaction to a single misunderstood comment? Or the first clear sign that Fortinet's growth story is running out of road? My name is Freeman. I'm an independent investor with a long-standing interest on U.S. tech stocks. I believe America's big tech companies offer some of the most compelling long-term growth opportunities anywhere in the world. However, lofty valuations make true bargains rare. That's why I'm always watching for moments of market panic, when even great businesses get oversold. Fortinet's dramatic plunge was one of those moments, and it sparked a deeper dive to answer one simple question: is this a bargain in disguise? Before we continue, a quick disclaimer. Nothing in this video is financial advice. I'm sharing my personal views and research for educational and entertainment purposes only. Always do your own due diligence before making any investment decisions. At its core, Fortinet is a cybersecurity infrastructure company. It builds the digital fences and firewalls that protect enterprise networks from threats, both external and internal. But unlike some other cybersecurity firms that focus on niche software or cloud-only solutions, Fortinet sells a broad, integrated suite of hardware and software with a strong emphasis on network security appliances. Its flagship product is the FortiGate firewall, which sits at the perimeter of corporate networks, inspecting and filtering traffic in real time. The cybersecurity space is massive, but we can simplify it into a few key layers. Network security, protecting traffic at the perimeter and across internal networks. Endpoint security, protecting individual devices like laptops and phones. Cloud security, protecting apps, data, and workloads in public-private clouds. Identity and access management, ensuring only the right people access the right systems. Security operations, detection, analytics, incident response. Fortinet's core strength is in network security, particularly next-generation firewalls, Secure Access Service Edge, a cloud-native model blending networking and security. Fortinet commands a vertically integrated position in the value chain, spanning everything from on-premises hardware firewalls to cloud-delivered security services. At the heart of this is its proprietary security fabric and UTM, Unified Risk Management Architecture, which connects all Fortinet products for unified visibility and control across hybrid environments. Crucially, Fortinet is one of the few cybersecurity companies that still designs and manufactures its own security hardware, and does so profitably at scale. Its use of custom ASIC chips allows it to deliver superior throughput and lower latency while keeping costs down, creating a price-performance edge over competitors that rely solely on off-the-shelf processors. Fortinet is one of the top global vendors in firewall solution, often ranked alongside Palo Alto Networks and Check Point. As of recent IDC and Gartner reports, Fortinet consistently holds number one in units shipped, with growing share among mid-market enterprises. Fortinet has also aggressively moved into SaaS, which integrates core networking functions like SD-WAN with advanced cloud security features. While not a pure play like Zscaler, its integrated solution is attractive to companies that want performance and security under one roof. Network security and SaaS are both part of the fastest growing subsectors in cybersecurity. According to Gartner and IDC, the SaaS market is expected to grow at an annual compounding rate of 26% over the next 3 to 5 years. Firewall refresh cycles still drive meaningful growth, especially in emerging markets and mid-size enterprise adoption. However, Fortinet's heavy exposure to hardware means it's more tied to capital spending cycles than some of its cloud-native competitors. That's precisely what spooked the market this quarter, the idea that the firewall refresh tailwind is fading. Now let's look at Fortinet's financials. First, its revenue growth has been consistent and compounding. Fortinet's top line has shown impressive steady growth over the past decade. Its revenues rose from $770 million in 2014 to nearly $6 billion in 2024, a roughly 673% increase. The growth has accelerated recently. 2022 to 2023 saw plus 20%, and 2023 to 2024 added another plus 12%. Next, the operating profit and free cash flow have been trending upward and accelerating over the past decade. Fortinet's operating profit has surged from just $55 million in 2010 to about $1.8 billion in 2024. That's a more than 30-fold increase. But even that pace doesn't tell the full story. In the last 3 years alone, operating income has accelerated, rising 49% in 2022, 28% in 2023, and a powerful 45% in 2024. In total, operating profit grew approximately 152% over that period, hitting an all-time high. That ramp-up underscores not just growth, but improving operating leverage and execution at scale. On the cash front, Fortinet's operating cash flow has risen steadily year after year. In 2020, it brought in $1.08 billion. By 2024, that figure had surged to $2.26 billion, more than double in just 4 years. As for the balance sheet, its apparent leverage is actually largely deferred subscriber payments. Total liabilities appear high, over $8 billion, but a large portion is deferred revenue, advanced payments from subscription customers, not long-term debt. Long-term interest-bearing debt, by contrast, remains modest, roughly $994 million at end of 2024, down to about $496 million as of Q1 2025. Its profitability and efficiency indicate exceptionally high returns. Fortinet's return on equity is in rarefied territory of 107% in 2024. It also enjoys a net profit margin of 30%, showcasing strong cost control and high pricing power. These financials reflect a company that is lean, scalable, and highly profitable, one with the DNA of a long-term compounder. The real question now is, at this new valuation, is Fortinet becoming a rare buying opportunity? Let's examine the valuation matrices. PE multiple. At $75.30, Fortinet trades at a trailing PE of around 30 times. Notably, this is close to its 10-year low, the long-term average being above 55 times and a 3-year average of 44 times. A 30 times PE still sets a high bar, with investors clearly expecting solid earnings growth in the years ahead. Management is guiding for a 12% CAGR in both revenue and billings over the next 3 to 5 years. Historically, however, Fortinet's net profit has grown much faster than revenue, thanks to expanding operating and net margins. This margin expansion comes from two main forces. First, a greater share of high-margin software and subscription services relative to hardware sales. And secondly, a high operating leverage. Fortinet's fixed costs in R&D, sales and marketing channels, and hardware production don't scale directly with revenue. Once these fixed costs are covered, each additional subscription adds very little incremental cost, allowing more revenue to flow straight to the bottom line. Analyst forecasts for Fortinet's earnings growth are all over the map, from as low as 6.3% per year, according to Simply Wall Street, to as high as 16%, based on estimates from stock analysis. That wide gap speaks to the uncertainty hanging over the stock after its sharp sell-off. Personally, I lean toward the upper end of that range. With Fortinet's strong margins, high operating leverage, and growing share of high margin software and services, I believe EPS growth can comfortably stay in the mid teens, around 15% or higher. With a projected earnings growth of 15% and a PE of 30 times, Fortinet's PEG ratio comes in at around 2. That tells us the stock isn't cheap, but it's fairly priced for a high quality, high profitability growth business. In other words, investors today are paying roughly twice the company's growth rate. By Peter Lynch's standards, that's expensive. But then again, companies with this level of profitability, market position, and growth potential rarely trade at bargain bin prices. A PEG ratio of 2 is considered fair based on Fortinet's historical range, which has generally hovered around that level since 2021. That said, if Fortinet exceeds earnings expectations, the PEG could fall below 2. Historically, the company's earnings growth has often outpaced revenue growth significantly, leaving room for upside surprises. If that happens, the stock could offer a compelling investment opportunity. Analyst estimates for Fortinet's intrinsic value are all over the map, reflecting differing assumptions on future growth, margins, and discount rates. Some models suggest a more conservative outcome, while others assume the company can sustain strong profitability and cash flow expansion. Personally, I prefer to base my estimate on Fortinet's historical earnings and cash flow trends. Using a 15% growth rate, in line with the company's EPS growth over the past few years, and project free cash flows with a terminal growth of 3%, I calculated an intrinsic value using a standard DCF approach. In that way, I arrived at an intrinsic value of $53 billion based on a discount rate of 9% and intrinsic value of $48 billion based on a discount rate of 10%. Compared with the current market cap of roughly $60 billion, this suggests that Fortinet is trading at a 13% to 25% premium to my intrinsic value estimate. On a strict DCF basis, the stock appears overvalued at today's price. However, there's an important caveat. Fortinet has a high operating leverage, and historically, earnings have grown faster than revenue thanks to margin expansion and the scalability of its subscription and software businesses. If the company can continue improving its profitability and cash efficiency, the intrinsic value could rise significantly, potentially turning today's premium into a bargain opportunity for long-term investors. Putting it all together, Fortinet still appears somewhat overvalued at its price of $75 to $80 at a conservative PEG of 2, even after the dramatic post-earnings crash. The current price is at a 13% to 25% premium to the intrinsic value based on my own discounted cash flow analysis. That said, a company of this quality rarely comes cheap. Fortinet operates in the fast-growing cybersecurity industry, where demand continues to surge in the face of escalating cyber threats. Its strong operating leverage, high-margin subscription growth, and consistent free cash flow expansion justify a premium. If the company continues to outperform expectations, today's price could still offer a compelling long-term opportunity. My view is that this investment carries moderate risk, since we're paying a premium, though not an extreme one, but also the potential for very high upside, as Fortinet is capable of delivering above expectation results. And as always, this is just my personal view as an independent investor, not financial advice. Please do your own research before making any investment decisions. Goodbye, and have a great day.